There is a moment, and history has shown us this over and over again, when the crowd all does the same thing at exactly the wrong time. They panic sell. They trade the one asset that was protecting them for the very thing that was destroying them. And if you own gold right now, I need you to hear me very clearly before you make that mistake. Because what is happening in the gold market as I record this is not a signal to sell. It is a signal that the move we've been talking about for years is only now truly beginning. Let me show you what I mean. Gold is trading at over $4,300 an ounce right now. Let that number land for a second. Not long ago, we were talking about gold crossing $2,000 as if it were some kind of miracle. Now we're past 4,000. Analysts at Goldman Sachs are talking about 5,000, 6,000, and beyond. And yet there is a growing chorus of people online, on social media, in financial chat rooms saying, take your profits, move back to cash, the run is over. And I want to spend the next several minutes walking you through exactly why that thinking is not just wrong, it could be catastrophically wrong for your financial future. Let's start with something fundamental that most people never think about. When you trade your gold back for dollars, what are you actually doing? You are exchanging a finite, non-reproducible asset, something that took millions of years to form in the earth and thousands of years for human civilization to accumulate, for a number in a computer system that a central bank can create with a few keystrokes. I want you to really think about that. Gold cannot be printed. Cash absolutely can. And right now, the people at the very top of the global financial system are telling you, not with their words, but with their actions, exactly which one they trust more. Central banks around the world have been buying gold at a pace that has not been seen in modern history. We're talking about over 1,000 tons per year from multiple consecutive years running. China, Russia, India, Turkey, Poland, these are not fringe countries acting on conspiracy theories. These are sovereign nations with massive reserves, sophisticated financial systems, and armies of economists. And they are choosing gold over dollars. BRICS nations alone now hold over 17% of global gold reserves, up from just over 11% a few years ago. The US dollar's share of global reserves has fallen to its lowest point since 1994. Think about that timeline. The last time the dollar commanded this little trust on the global stage, the internet barely existed. The world has changed dramatically since then, and the dollar's role in it is changing too. Now, if you're still watching, I want to share something with you. I put together a completely free guide in the description below. It shows the saving secrets that thousands of American retirees are already using to protect their hard-earned wealth in this kind of environment. Go check that out after this video. It won't cost you a thing. Back to where we were, because I want to go deeper into why this moment is different from any other moment in modern financial history. Here's the story that doesn't get told on mainstream financial news. The gold market, the one that sets the price you see on your screen every day, is not primarily a market for physical gold. Let me say that again. The market that determines the price of gold is mostly a paper market. It operates on something called COMEX, the commodity exchange in New York, and it functions on futures contracts. These are legal promises to deliver gold at some point in the future. The problem? And this is where it gets almost surreal. The total amount of gold represented by outstanding paper contracts on the market is roughly 22 times the total amount of physical gold that actually exists on the planet. 22 times. Over 4 million metric tons in paper promises against approximately 200,000 metric tons of real physical gold in the entire world. What does that mean in plain English? It means that if even a fraction of the people holding those paper contracts ever decided to demand physical delivery, to say, no, I don't want your settlement check, I want actual gold bars, the system would break. There is not enough gold to satisfy all those claims, not even close. And here's what's fascinating. The cracks are already starting to show. Delivery requests on COMEX have been rising. Delivery times have been stretching. Premiums on physical gold, the extra amount you have to pay above the paper spot price to actually hold metal in your hand, have been elevated in ways they normally aren't. Over 2,000 tons of gold were physically transferred to the United States as institutions began losing confidence in foreign storage arrangements. This kind of physical movement doesn't happen in normal markets. This is a stress signal. Now, let's put this in a historical context, because I think what's unfolding right now rhymes very loudly with two particular moments in history that should make every gold holder sit up straight. The first is 1971. Most people know the headline: Nixon closed the gold window. What fewer people appreciate is what actually happened in the lead up to that decision, and what happened in the years immediately after. For most of the post World War II era, the US dollar operated on what was called the Bretton Woods system. Every dollar in circulation was technically backed by gold at a fixed exchange rate. Foreign governments and central banks could hand dollars back to the US Treasury and receive gold in return. For decades, this created discipline in how many dollars could be printed. But as the costs of major social programs and overseas conflicts ballooned in the late 1960s, the US government began printing dollars far beyond what its gold reserves could justify. Countries like France, and Charles de Gaulle was famously vocal about this, saw what was happening and started demanding their gold back. The French sent battleships to New York Harbor to bring gold home. West Germany, Switzerland, they all saw the writing on the wall. By August of 1971, the pressure on U.S. gold reserves was so severe that Nixon had no choice but to announce on a Sunday evening in a television address that the U.S. would no longer honor those gold redemptions. The gold window was shut. And what happened next? Gold, which had been fixed at $35 an ounce for decades, exploded over the next decade to over $800 an ounce, a more than 20-fold increase. The people who held gold through that transition didn't just preserve their wealth, they multiplied it dramatically. The people who cashed out early, who said, "I'll take the dollars, the system will hold," many of them watched inflation quietly destroy their purchasing power year after year. The second historical moment I want you to think about is 1980. This is the moment that most people have heard about as the gold bubble that burst. And yes, gold did correct sharply from its peak, but here's what gets left out of that story. The people who bought gold in 1971 or 1972 and held it through to the early 1980s, even accounting for the crash, still made extraordinary returns. The lesson of 1980 is not gold is dangerous. The lesson is that you need to understand what you own and why you own it. The people who panicked in 1980 were largely late buyers who had bought near the top for speculative reasons. They didn't understand the underlying fundamentals. The people who had owned gold as a long-term wealth preservation tool, as a hedge against monetary debasement, many of them continued to hold and were ultimately rewarded. Now, here's the question you need to ask yourself. Which category do you fall into? Are you someone who bought gold recently because you heard it was going up and wanted to make a quick trade? Or are you someone who owns gold because you understand what it is? Real money, a store of value, protection against the long-term decay of purchasing power. Because if you're in the second category, the case for holding has never been stronger. And if you're in the first category, I'd encourage you to take the next few minutes to understand why the fundamentals here are unlike anything we've seen in living memory. Because what's happening right now is not just a gold story. It is a story about a fundamental restructuring of the global monetary order. And those restructurings, when they happen, do not play out over weeks or months. They play out over years, sometimes decades, and they reward patience. They punish short-term thinking. Let me walk you through the mechanics of what's actually driving this. The US government is running deficits that are, by any historical standard, extraordinary. Not extraordinary in a record-setting, one-time event kind of way, extraordinary as in this is now the baseline. Year after year, the gap between what the government spends and what it collects in taxes has grown to a scale that previous generations would have found unimaginable. The total debt load is now measured not in hundreds of billions, but in the tens of trillions. And that debt has to be financed. It gets financed by issuing treasury bonds. And those treasury bonds are increasingly being purchased not by foreign central banks, who used to be reliable buyers, but by the Federal Reserve itself, essentially through money creation. When a government finances its spending through money creation, the result is always the same across history. The purchasing power of that money falls. This is not a controversial claim. This is what inflation is. And the inflation that we've seen over the past several years, the kind where your grocery bill looks meaningfully different from what it did a few years ago, where your rent has climbed to levels that would have seemed absurd to your parents, that is not a temporary blip. That is the visible manifestation of monetary expansion catching up to everyday prices. And gold, throughout all of human history, has been the asset that you hold when you understand this process. Not because gold necessarily goes up in a straight line. It doesn't. Not because gold pays you dividends or coupons. It doesn't. But because gold, over long periods of time, preserves what it represents. An ounce of gold 100 years ago could buy a very fine tailored suit. An ounce of gold today can still buy a very fine tailored suit. Can you say that about the dollar bills that were sitting in someone's mattress 100 years ago? Now I want to talk about something that I think is the sleeper story of this entire gold market. The one thing that most retail investors have no idea is happening. It has to do with how gold gets traded on a global scale, specifically in the market that operates out of London. The London Bullion Market Association, or LBMA, operates what is effectively the world's largest over-the-counter gold trading market. And here's the thing about the LBMA that most people don't know. Much of what gets traded there is not gold that anyone can actually hold in their hands. It's unallocated gold, essentially a claim on a pool of metal that a bank promises is there, somewhere, in some form. When you own unallocated gold through a bank, you are technically an unsecured creditor. You don't own specific bars with serial numbers. You own a promise. And in the event of a serious financial crisis, a bank failure, a liquidity crunch, a run on the system, that promise may be worth exactly as much as the counterparty standing behind it, which might be very little. This distinction between allocated and unallocated gold, between physical and paper, between something real and a financial promise, is one of the most important financial concepts that almost nobody talks about in mainstream financial media, and it's becoming more relevant by the day as the stress signals in the paper gold market continue to build. Now here is where I want to address something directly. Maybe you're watching this and you're thinking, okay, I understand the case for gold, but at these price levels, isn't it too late? Haven't I already missed the move? And I want to walk you through why the analysts who have studied this most carefully are suggesting the answer to that question is no. Goldman Sachs has a price target in the $5,000 range. JP Morgan has been talking about the mid-5,000s. Some of the more bullish commodity analysts are looking at $6,000, $6,300 an ounce as a realistic level before the current secular bull market in gold finds its equilibrium. And if you look at the long-term structural analysis, the trajectory of global debt, the pace of monetary expansion, the de-dollarization trend, the institutional accumulation by central banks, the supply constraints for mining, the logic behind those targets is not speculative. It's grounded. Think about the math for a moment. If gold goes from where it sits today, call it around $4,300 an ounce, to $5,000, that's a meaningful increase. To $6,000, that's an even more substantial move. And for anyone sitting in retirement accounts that have been battered by equity market volatility, by bond markets that failed to protect during inflation, by financial instruments that carry counterparty risk, the argument for having meaningful gold exposure as a stabilizing force in your portfolio is overwhelming. Which brings me to something I want to mention briefly for a specific group of people watching this. If you're in or approaching retirement and you have $100,000 or more sitting in a traditional IRA or 401k, there is an option that most financial advisors never bring up in the first consultation. You can actually move some of those retirement dollars into physical gold. Not gold mining stocks, not gold ETFs, not unallocated promises, but actual physical gold that gets held in a secure IRS-approved depository inside a structure called a gold IRA. This means you get the tax advantages of your retirement account while also getting the protection of real allocated metal. And given everything we've talked about, the monetary environment, the geopolitical landscape, the fragility in paper markets, the long-term erosion of purchasing power, having a portion of your retirement in something that central banks themselves are choosing to hold over dollars seems like a conversation worth having. If you want to explore what that looks like for your specific situation, there's information in the description below. Let me come back now to the core thesis, because I want to make sure this lands. The argument against trading your gold back for cash is not simply that gold's price might go higher. Price alone is the wrong frame. The right frame is this: what problem does gold solve in your financial life? And the answer to that question has everything to do with the world we are actually living in right now, not the world that existed 20 years ago or even 10 years ago. The geopolitical situation that underpins global financial markets has shifted in ways that are permanent. Countries that once had no interest in alternatives to the dollar-dominated financial system are now building those alternatives at an accelerating pace. The BRICS bloc is not going away. The gold accumulation by sovereign nations is not going away. The distrust in paper financial systems, the kind of distrust that builds slowly and then breaks all at once, is not going away. These are not temporary mood swings in global finance. They are tectonic shifts. And then there is the domestic picture. When the purchasing power of a currency erodes gradually, most people don't notice it day to day. You don't feel it in any single transaction. You feel it over years when you look back at what your money used to buy versus what it buys today. The retirement account you built over 30 years of careful saving might look impressive in nominal dollar terms, but what will those dollars actually purchase when you need them most? That is the question that gold answers. Not perfectly, not without volatility along the way, but across the sweep of history, nothing else has answered that question as reliably. There's a reason that the oldest and wealthiest families in the world, across generations, across continents, across currencies, have always kept a meaningful portion of their wealth in gold. Not because they were paranoid, not because they didn't understand modern finance, but because they understood something that the modern financial industry has worked very hard to make everyone forget, that paper wealth and real wealth are not the same thing. And when the gap between those two things gets corrected by history, as it always eventually does, you want to be on the right side of that correction. The 1971 moment, the 2008 financial crisis, where gold actually rose through the carnage of collapsing financial institutions. The inflationary surge of the late 2020s that took so many retirees by surprise. Each one of these events carried a lesson, and each time the lesson was the same. The people who held real assets, who held gold, came through in better shape than the people who held promises, who held paper, who held faith in a system that turned out to be more fragile than advertised. So when I say do not trade your gold back for cash, I'm not telling you gold will never have a bad quarter, or that you should put every dollar you have into it, or that you don't need to think carefully about your personal situation. What I am telling you is this: understand what you own, understand why you own it, understand the forces that are driving this market, not the short-term noise, but the deep, structural, multi-year forces. Central banks are buying gold because they understand something is changing. Institutions are taking physical delivery because they understand something is changing. Countries are building alternative financial architecture because they understand something is changing. The question is not whether you own gold. You do. The question is whether you understand it deeply enough to hold it through the noise, through the dips, through the occasional corrections, through the moments when the mainstream financial media tells you the run is over and it's time to rotate back to equities or cash. Because those moments, and history is very clear on this, are almost always the moments to hold tighter, not let go. Now, if you've made it all the way to the end of this video, I want to say something just for you. Because you've clearly got the kind of mindset that takes this seriously, and I want to make sure you have everything you need to act on it. The free guide in the description lays out the specific strategies that many American retirees are quietly using to protect their wealth. But beyond that, if you're someone who has at least $100,000 in any retirement account, an IRA, a 401k, a 403b, anything, and you mention that you watched this video all the way to the end, you can qualify for a completely free, exclusive, one-on-one educational web conference. No obligation, no sales pressure. Just a genuine conversation with someone who can walk you through exactly what these strategies look like for your specific situation. That offer is in the description, but it is only available to American retirees who meet that threshold. So if that's you, go check it out. The information is there. The history is clear. The central banks have already voted with their vaults. The only question left is what you're going to do with what you now know.